The Fed just paused interest rate changes amid inflation concerns. How will this impact your money and the U.S. economy right now? On its latest policy meeting, the Federal Reserve's Federal Open Market Committee decided to keep the federal funds rate steady. This decision was widely expected and reflects rising concerns about inflation even as it has eased significantly since 2022. This pause could indicate that the Fed is watching inflation and labor markets closely before making further moves. The federal funds rate is the interest rate at which banks lend to each other overnight, influencing borrowing costs across the economy. The federal funds rate set by the Fed directly impacts how banks borrow and lend money, which in turn affects your personal loans, mortgage rates, and credit card interest. When the Fed raises rates, borrowing gets more expensive, cooling down spending and inflation. When it holds rates steady like now, it means borrowing costs aren't increasing, but inflation concerns remain on the horizon. This balance is crucial for your monthly budget and financial planning. Inflation pressures have eased considerably since 2022, but the Federal Reserve's goal of returning inflation to 2% remains uncertain. Fed officials, including former members like Warsh, emphasize the need for inflation to moderate further and for labor markets to soften before considering rate cuts. This cautious stance explains the Fed's decision to hold rates steady rather than lower them, signaling that inflation remains a key risk to watch. This policy meeting is likely the last for Jay Powell as Federal Reserve Chair. Under his leadership, the Fed navigated historic inflation spikes and rapid rate hikes. The decision to hold rates steady now may set the tone for the Fed's next leadership amid ongoing economic uncertainty. Powell's legacy includes balancing inflation control with support for a stable financial system, a challenge that remains as the economy evolves. Looking ahead, the Fed's next steps will hinge on economic data. If inflation pressures ease further and the labor market softens, the Fed may consider adjusting rates. However, the path back to a 2% inflation target is unclear, making future monetary policy decisions more complex. Markets and consumers should prepare for continued uncertainty as the Fed carefully calibrates its approach to sustain economic stability. The Federal Reserve's decision to hold rates steady shows a cautious approach to inflation and the economy. For you, this means borrowing costs remain stable for now, but inflation risks aren't over. Stay informed to make smart financial choices as the Fed's policies evolve. Subscribe for the latest updates on how these decisions impact your wallet and the wider economy.